Hey guys, Dave Keller here with Market Misbehavior. Part of my normal routine is looking at hundreds of charts every day, and some of that is through routine. So every morning I have a set of charts that I look at. Every week I have a set of charts that I look at, including the entire S&P 500, stock by stock. This is something I've done for years to help me make sense of what's happening and how the markets are evolving. But at the end of the day, my process really focuses on key levels. What level? What's a line in the sand at which I would agree to change an opinion or change a position or change a recommendation or perspective on a particular chart? And what I want to do today is share with you 3 key levels on 3 key charts. So as I go through my normal routine of analyzing hundreds of charts every day, you have to simplify. You have to come up with what I call lines in the sand. I often, when I'm talking about particular charts with clients and viewers, focus on the line in the sand. What's the line in the sand at which you agree that whatever position you're in, you have to reverse the position or at the very least reevaluate your position? We're going to focus on 3 key stocks today: Apple, Tesla, and Facebook, and focus on what I see are the lines in the sand for each one of them, how I came up with it, why I follow them, and why I think they're very important to watch going forward. Before we get to those 3 charts and the 3 key levels, if you like this sort of thinking about investor behavior, decision-making routines, and investor psychology using charts and technical analysis, I hope you'll subscribe to the channel. It'd be great to have you along this ride. Also, give the video a like if you could. We'd very much appreciate it. Finally, I'd love for you to answer in the comments below, which of these three stocks do you think is most well-positioned to outperform over the next 2 to 3 months? Apple, Facebook, or Tesla? Let me know in the comments below. Now let's get to the charts. All right. So as I mentioned, I often, every day go through hundreds of charts, and this is part of, I think, the process of being a technical analyst. Is by definition you look at a lot of charts, and so it's a very visual form of analysis. But when you're looking at hundreds of charts every day, it's hard. It's not like you're just looking at one chart and you're just following it moment to moment. I'm looking at a chart, and then 30 seconds later, I'm off to 10 other charts, and so you often have to simplify. You have to have a way of organizing your thinking on all of these different stocks, especially if you're looking at equities and you have a pretty broad universe. I was talking with a friend of mine in India, and we were relating the Indian equity markets to the US equity markets. And the reality is the US equity markets are just way more liquid, and there's just a lot more stocks that are traded here. And as a result, it's overwhelming at times to try to make sense of all these different groups and themes and patterns. So for me, I've often told people, don't treat your charts as a painting, as a picture that you would hang on the wall. Treat it as a workbook. This should be a living, thing, and updating your thoughts. It should be a real-time way to capture what you're thinking at any moment. So I use on StockCharts our chart list feature, which allows you to save different charts in different groups and allows you to save your annotations. So I'm simplifying here, looking at 3 key charts. And these are charts that have come up in the last couple of days that I've been talking about and writing about. And I just want to focus on how I come up with the lines in the sand for each one of these. And I would argue right now, these are 3 really important charts to watch if you want to understand whether or not the market is in recovery mode from here when people are going back to a risk-on environment and pushing stocks higher, or if it's time to get defensive and more of a risk-off environment. I think these 3 charts are going to be pretty helpful in terms of differentiating those. So chart number 1 is Apple. I went on Bloomberg TV earlier this week, and this was one of the charts that we looked at. And, to take a step back a little bit, if you look at Apple back here in last fall, so this is the run up to its peak in September, you had this bearish engulfing pattern here. And then we settle into this sideways trend, this consolidation pattern, or what we would call a symmetrical triangle or coil pattern. This is where you have a pattern of lower highs and higher lows. So it's really focusing on a particular price range here. It's rotating around the 116, 118 level, and you can see the highs are getting lower, the lows are getting higher. So after a big move, this is called a consolidation pattern, where you're sort of at an equilibrium, you're trading around the midpoint of this pattern. Now, one of 2 things is going to happen when you have this pattern. Either you break above the upper line, if I would draw a line connecting these highs, either you break above the upper boundary or you break below the lower boundary. And whichever way you break that pattern, the argument is that's the most likely future direction. That's the future path to be paying attention to. So what happened here? The S&P topped out here in early September as well. This is when a lot of the
cyclical sectors like financials and energy started to do really well. All of a sudden, industrials, materials started to emerge as well. And here you can see that Apple, one of the biggest technology stocks and one of the biggest names in the S&P, is consolidating. But look what happened here in November into December. You broke out of the pattern to the upside. So the consolidation pattern resolved higher. That was one of the indications that gave sort of an all clear for stocks, telling you it was back to a risk on mode, and Apple was rotating back to the upside. We have a similar pattern now. After the peak in late January for Apple, you now have a lower high and higher lows over this last 3-month period. So if take the February and April highs, connect that with the trend line, you take the March lows and connect that to the lows here in early April, into May, in early May, and you get to where we're at right now. So now you have this similar consolidation pattern. This has to break one of two ways. Either it breaks above the upper boundary, signaling a return to the risk-off environment, or it breaks below the lower boundary, indicating more of a risk on to the upside and risk off or defensive breakdown. So right now, we're just bouncing today off of the lower boundary. Again, we've done it twice in 2 weeks now. So if you take this trend line using the recent lows, you'll see that that lines up almost perfectly with the 200-day moving average. So that is what I would consider a high probability line in the sand. As long as we remain above trend line support, remain above the 200-day moving average, overall, Apple is still at least in consolidation mode. But if we would break this to the downside, there's a high potential for capital loss. There's certainly a strong potential that Apple goes down materially lower from here. And the reason why that could happen is because a lot of investors that are holding Apple, especially money managers, where this is a huge part of their benchmark as a $2+ trillion market cap company, if this starts to break down, and if owning Apple, which you have to do as a money manager when it's doing well, if it starts to really do poorly and it starts hurting your returns, it makes it more difficult for you to outperform the S&P, you are much less likely to be motivated to own that stock. You're going to rotate to other defensive parts of the market that are going to hold up a little better. So if it would break through this trend line support and break down through the 200-day moving average, I think you could see a huge acceleration to the downside because the further lower it goes, the more motivated money managers would be to lighten up in their position and rotate somewhere more defensive. That selling would in turn push the price even further, and it becomes a feedback loop of lower and lower prices. That's when sell-offs can really accelerate to the downside. So that is the line in the sand, I would argue, for a chart like Apple. Tesla is obviously a name a lot of people talk about. It's funny, when I was thinking of this video, I originally was going to call it like 3 top charts in technology. And I realized that only one of the stocks I picked were actually in tech, but you think of Tesla and Facebook as technology companies because they are. It's just the way that they're applying technology in the consumer space or in the internet space, which is now part of communication services. So having said that, key chart number 2 is Tesla. Now with Tesla, this is more of an exercise on support and resistance, along with some other things as well. If you look at the run in Tesla from the March market low to the peak that it saw in late January, so it peaked around the same time that Apple did, by the way, you can see it pulled back around 38.2%. That's that purple line, the first Fibonacci support level. That's taking the low from March, the high from January. You take that as your frame of reference, you go down 38.2% of the way, and that ended up being the March low and also the late March low, early March and late March. We bounced right back to that level, and so far, arguably, we've broken below it and followed through. So at this point, it's a fairly negative pattern. What's interesting now, as it's also broken down through the 200-day moving average, is we are now right at the March lows. And I would argue this is the last line in the sand. If it breaks this level, which is just around 550. So if it breaks just a little bit lower, which would take up below the March low, I would argue that clears the way at least to the next Fibonacci retracement level, which is 61.8%, which is just below $400 a share. It's another 150 points below where we're at right now. That would also line up very well with this phase, September, October, November of last year. So this is that after that big run into the September peak, Tesla settled into that very similar price range. So it would make a lot of sense given a breakdown of 550 that a move down to 400, which would be a Fibonacci level and also a previous level of price support. If applying Fibonacci retracements, by the way, is not something you're familiar with, a little earlier this week, I recorded a video on Bitcoin, particularly using Fibonacci retracements, talk about how to determine what levels to use, how to use some of the levels, and how to understand price movements relative to those levels. So if you missed that, or if you're not familiar with Fibonacci retracements, check out that other video on the Market Misbehavior channel. So chart number 2, Tesla, that's the line in the sand around 550. Finally, we have Facebook. And out of the three, you can just see by the price characteristics, the fact that the price is going up and not consolidating like Apple is doing or going down like Tesla is doing, Facebook is actually in an uptrend. It's recently broken to new all-time highs and has been falling through to the upside. Look at the relative strength. You can see that it's sloping higher, showing that it's been outperforming the rest of the market for the last couple months. So why this pink line is an interesting line, or what I call a line in the sand for Facebook. This was the peak in late August, early September. We then retested that level again in November. We retested it once again in March. Then we finally broke above it in early April. You can see then we came back, and from above, we tested that level from above. And so this is called a parity point, or a level where you found resistance and then it becomes support, which happens very often in technical analysis. And now we bounced off of that level in mid-April. We bounced again in early to mid-May, and now we're rotating back to the upside. So as long as we remain above that pink trend line, that tells you that this was a basing pattern with a breakout and a retest, and most likely the path of least resistance is up. This is a stock in an uptrend. But what happens if it breaks below $300 a share, breaks below that support level and no longer is able to hold that? All of a sudden, that would be a very different pattern. From a pattern of higher highs and higher lows, that would be a pattern of lower highs and lower lows. That would be a short-term downtrend. At that point, I think you have to look down to the 200-day moving average, which is around 278 right now. Below that, the lows from March and the lows from January, which are down in the sort of 245 to 255 range. So given a break below 300, I think you have to look back to those further support levels. So with any of these charts, and again, looking at 100 charts a day, I can't remember every single level and what price points they are. I've known some analysts and traders that are like that have a photographic memory. I certainly do not. And so I use these charts as a workbook, a way to save what I'm seeing and what I'm thinking, and drawing key lines in the sand. And then again, all you need to do is review the charts regularly. When you break those levels, when that happens, then you've agreed to change your position, take profits, get defensive, go to cash. At the very least, review your thesis and make sure you're uncomfortable with the fact that the price is no longer doing what you'd expected before.
So those are three key lines for three key charts, looking at Apple, Tesla, and Facebook, using a couple different techniques: pure support and resistance, Fibonacci retracements, price patterns like a symmetrical triangle. But the consistent theme is this. Overall, I have found, looking at a lot of charts all the time and having a lot of different equities you can be analyzing, a good investor, a mindful investor, uses charts like this to help them make sense of things, to help quantify where they would agree to exit a position or reevaluate a position. And for me, it's all about the line in the sand. At what level do you agree that your original thesis may be incorrect and that you have validated a new potential outcome? And what do you need to do because of that change? If this sort of discussion about investor decision-making routines, charts, and technical analysis is of interest to you, I hope you'll subscribe to my channel. Please give the video a like if you could. We'd very much appreciate it. Finally, put a comment below the video. Which of those three stocks, Facebook, Tesla, Apple, do you think is best positioned for the next 1, 2 to 3 months, and why? From everyone here at Market Misbehavior, I'm Dave Keller. Be well, trade safely. Talk to you soon.